What if I told you that the secret to trading success isn't just about finding the perfect setup? It's about building the perfect system, one that transforms you into a consistent, disciplined trader. Welcome to our lesson on routine building and self-review. Let's start with a fundamental truth: success in trading is built on habits, routines, and systematic self-review. It's not about one brilliant trade, it's about hundreds of trades executed with structure and then reviewed with a critical eye. The purpose of this lesson is to give you the blueprint to design these powerful practices for yourself. Why is a routine so non-negotiable? It creates structure and consistency in a chaotic environment. It reduces emotional decision-making by automating your process. And it encourages the discipline needed to stick to your strategy, especially when the market tests you. A strong routine isn't just about the hours you trade. It's a three-part system: pre-market preparation. This is your strategic session. Review the broader market structure, identify your key liquidity zones and order blocks, and, crucially, set your trading goals and risk parameters for the day. During trading, this is pure execution. Follow your plan, record your trades in real time, and maintain a sharp awareness of your emotional state. Post-market analysis. This is where the learning happens. Log your results, review every decision against your plan, and update your journal. This step turns experience into expertise. So, what does this look like in practice? Morning, dedicate time for market analysis. Review the higher timeframes, identify the day's opportunities, and set your alerts. Trading hours. This is your focused execution window. Your only job here is to follow the plan you made earlier. Evening/night. This is your reflection period. Journal your trades, assess your emotional performance, and review the outcomes. This closes the loop. For our SMC traders, here's a concrete example: 30 minutes before trading, your pre-market prep. Check for high-impact economic events, mark your key SMC levels, like liquidity pools and order blocks, on the chart, and set your price alerts. 1 to 4 hours during trading, your focused session. Trade only your predefined setup, enforce strict risk management, and above all, be patient. 15 to 30 minutes after trading, your review. Record your trades, reflect on what you learned, and apply that lesson to tomorrow's plan. Now, let's talk about the engine of improvement: self-review. This is how you ensure you're not just repeating the same mistakes. It allows you to learn objectively from past trades to make better future decisions. It provides an honest evaluation of both wins and losses. And it's the best tool to identify patterns in your mistakes and hidden biases. Effective self-review is layered. Maintain a detailed journal. For every trade, record your rationale, your emotional state, and whether the outcome matched your plan. Conduct a weekly performance review. Step back. Look at your statistics, win rate, risk to reward. Evaluate your decision-making process as a whole. Perform a monthly summary. This is big picture time. Identify any recurring errors and set specific, measurable goals for the next month. Don't just track P&L, track the inputs that create your P&L. Key metrics include your average risk-to-reward ratio, your trade frequency, are you overtrading? Your adherence to plan, what percentage of trades followed your rules? Your common emotional triggers and your SMC zone identification accuracy. It's incredibly difficult to see our own blind spots. This is why feedback and accountability are so powerful. Discuss your trades and routines with trusted peers or a mentor. Be open to constructive criticism. It's the fastest path to growth. Your routine isn't set in stone. You must optimize it. Regularly identify bottlenecks. Are you spending too long on analysis? Test new techniques for efficiency. And most importantly, keep it simple and sustainable. A complicated routine is a routine you won't follow. Be aware of the common traps. Skipping journaling, the single biggest mistake; emotional neglect, pretending your psychology doesn't matter; overcomplicating your routines and ignoring your mistakes and only celebrating wins. As we conclude, remember these 3 principles. Structured routines create the consistency that leads to profits. Rigorous self-review ensures you are always improving. Ultimately, simplicity, discipline, and honest reflection are what will unlock lasting success in trading. Build your system. Review your progress. Master your craft. Thank you for watching.